you for joining us for our webinar today on managing your retirement accounts. My name is Josh Antus. I am Financial Education and Community Partnerships Manager for California Coast Credit Union. And I will introduce Kyle, our presenter today, in just a moment. But I just want to say thank you to the Public Library System for your partnership for today's webinar and our future webinars that we're going to host as well. We have a partnership with the City of San Diego. We are the official financial partner of the city. And just a little bit about Cal Coast, we've been around for over 90 years now. We've always been based in San Diego. And as a credit union, we are not-for-profit. So a lot of what we do is community-based, very local, and we like to provide value in products and services, such as webinars like today's, at no cost to our members, to the community, to our partners, to whoever we can. So we appreciate you being here today. Just some quick housekeeping items. Everyone will be placed on mute for the duration of today's presentation, but if you have any questions, please feel free to go ahead and incorporate them into the chat box or the question and answer box. We'll take a look at those and answer those as we go. And we also will have a survey at the end of today's session for you that will either pop up or you can answer it. It'll come to you by email in the next day or so. That survey is really great. It's useful for us. It gives us an idea of how we can improve as we go, what topics you're interested in learning about in the future. And if you do want to follow up with any one of us in regards to any of our products and services that we offer as a credit union or through our financial services, there's a follow-up a request on that survey, so you can indicate that you'd like one of us to contact you, and we will do so. With that, I want to go ahead and introduce Kyle Johnson. He's with the Cal Coast Financial Services wing of the credit union, and Kyle is one of our financial representatives that, I don't know if you caught it, but just a minute ago, he and I were talking about stocks and retirement and ourselves. I always have questions for him. So, but he's a wealth of knowledge. He's really incredibly bright when it comes to this kind of thing. And today we'll focus on retirement, but he'll tell you a little bit about what he can help you with in general. Kyle, I'll hand it over to you.
Thanks, Josh. That was a very gracious opening. I appreciate it. Maybe a little too gracious, but thank you. Yeah, so I'm a financial advisor here. We help people plan and invest and plan for retirement. So anything from finding maybe alternatives to your CD, to managing your portfolio, to planning for retirement. We are the financial kind of experts for Cal Coast. So today's presentation is going to be pretty basic, but it's also a really important presentation. And a lot of more members than you'd think have questions about essentially rolling over. So when to roll over, what are your options, things like that. That's what we're going to cover today. If I know that you came here, it's managing your retirement accounts. We're actually going to be talking about how to manage your actual retirement account if you happen to leave a job. Now, if you have questions about managing your specific account, I'm more than happy to answer that. So feel free to chat in the box. If you had some specific questions today, just send me a chat and I'll try to deal with that at the end. So I'm going to keep the actual presentation brief and leave a little bit of extra time for questions if you have any. So I'm going to go ahead and get into the retirement account portion of it, and we'll take it from there. So on average, Americans have 12 different jobs by the time they turn 52 years old. So wherever you are, there's a really good chance that you may not stay at the company that you're currently at. You might like it right now, but things change, life changes, you may move states, things like that. And so it's really important to be aware of your options if that happens. So here's a few options that you have, right? So one, you can leave it in your plan. Right? You can keep it exactly how it is at your employer plan. Two, you can convert it to cash. Three, you can move it to your new employer's plan. And four, you can take it with you to a rollover IRA. We're going to cover some of the benefits and downsides of each. So option one, save put, leave it in the plan. You can often keep your retirement savings invested in your old plan after you leave your job. right? So some of the benefits of doing that is that everything stays as is, right? You don't lose any sort of tax savings. There's no penalties. And if you happen to have employer stock plans, you'll still retain the same types of tax benefits that you would have had, right? Cons, your investment choices might be limited, right? So many 401k plans are going to have just your bare basic types of options, right? So it's going to be some target date funds based off of your age and when you're expected to retire. Number two, it's going to be a few different investment options, such as some large cap options, maybe an S&P option, maybe a couple of international and some bond options as well, right? So usually probably 10 to 15 options on the investment side of things. That tends to be pretty limiting. Especially as you get closer to retirement age. Now, we're going to talk a little bit more about converting it to cash, right? So one, you leave the plan as is. Two, you convert to cash. What does that look like, right? So generally speaking, this is probably the least recommended option out of all of them, right? So the pro, pretty much one, you have your money, right? So you convert your money to cash and there it is. So the downside of it is that distributions are probably going to be subject to penalties if you're under 59.5, right? So there's a 10% penalty if you're under 59.5. Two, it's going to look like income. And so income is taxed at a higher rate. So if you have a large balance in your 401k, all of that is going to look like income in the year that you take it, right? So let's just say you have $200,000 and you take that out. That's going to look like you had $200,000 of extra dollars during that year. That's going to probably bump you up in one or two tax brackets. And it's going to be probably pretty inefficient from a tax perspective. So again, income taxes due at current rate. You're going to have a 20% mandatory withholding. So even if you want to go down to Mexico and escape with your funds, you can't do that. They're going to automatically withhold 20%. And you're going to have, again, 10% penalty on early withdrawals. So if you have, let's just say $50,000, here's an example. Essentially, between the fees and taxes, you're going to end up with $33,000 at the end of it. One of the biggest benefits of having your money in a what we call a tax deferred or a qualified plan is that there is special tax treatment, right? And special tax treatment means that it's going to be an advantage for you to grow your money over time. So, so for an example, if you had your $50,000 and that was growing for 8% per year for 25 years, that $50,000 would be $367,009 by the time you retire, right? Now, if you were to cash out and you had that, and you had double the amount invested, right? So instead of 50,000, you have 100,000. Now you take taxes. Now you take the amount that you took out. The exact same return, exact same amount of years, but you had double the amount saved. Now you have even less in retirement by a significant amount. So really that compound interest and that compound earnings growth over time is one of the biggest benefits you have. So it's really important that if you do move it, that you're cognizant about how you move it and that you're cognizant of taxes. So option 3 is moving it to your new employer plan. So you leave a job, you move it to your new employer, right? This is going to be a very cost-effective way to do it. Some of the pros, your retirement assets are under one roof. Some plans offer special investment options such as employer stock purchase programs, things like that. And so again, now moving it from your old employer to your new employer, you're probably going to run into a lot of the same issues, right? So you have very limited investment options, right? Either the target date funds or just the handful of investment options that are decided by the plan. The rules governing withdrawals are based off the plan's provisions, right? So anytime that you have a 401k, the plan is really going to be dictating a lot of the rules of how you contribute money and how you invest your money and how you withdraw your money, right? In an IRA, you don't actually have any of those. It's pretty independent, and you can choose your investment options and how you withdraw. So, another option, another issue with having an investment plan in your old 401k that I've run into for a few, if you leave it in your old 401k, that I wanted to bring up is that sometimes they change investment providers for their 401k. And oftentimes, when they do that, they're not going to automatically reinvest you into another plan, right? So what they're going to do is they're going to probably put you into cash rather than an investment. And so if you're not cognizant of that, and if you're not watching your investments, you could be sitting in cash for a very long time. I've seen that a few times with some clients. So I did want to bring that up. So option 4 is you could take it with you with a rollover IRA. So you could transfer your savings to a rollover IRA without any taxes or penalties. So this is what I was talking about before. So you have a wider range of investment options. So let's just say you wanted to buy a share of Amazon. If you roll it into an IRA, you can now do that, right? Rather than having this be a just a few different options or being stuck in that target date. You have an option to take withdrawals before the age 59 and a half without penalties. And then you can convert assets to a Roth IRA if you want to, what we call a backdoor Roth conversion, right? We can talk about that a little bit later, but essentially it allows you to transfer some of your money from a regular IRA to a Roth IRA, even if you're phased out of Roth contributions, right? You're still going to take a tax penalty on that. It's still going to look like income, but it's an option. Also, everything is just going to be, you're going to have it outside at the one location for life, right? So let's just say, for some clients, I like to use Charles Schwab. You could have that Schwab account, you could have it open, you could manage it, and no matter which job you go to, that same login, that same account, and everything is going to be in the same place, right? So 2 ways to roll over your savings, right? One is a direct rollover. A direct rollover is when you take your money directly from the plan and they write either a check or they do an automatic transfer to your new account, wherever that account may be. So either it's a 401k or an IRA, right? This is really the preferred way to do it. As long as your name isn't on the check, that's what we call a direct rollover, right? So, and some people are surprised that they actually do write checks, and yes, a lot of places will write checks. And so they will issue it from the fiduciary here to the new plan or to your IRA, and they'll issue the check or the payment to Schwab rather than you. So this is going to be very clean, no income taxes, no mandatory withholding, and no IRS penalty for the withdrawal. The other way to do it is an indirect rollover. So what they do in this scenario is they're going to write your name on the check. They give you the check. And what you can do is you can reissue that to a new plan, right? So either your new plan or to, a new IRA account, wherever you want to hold it, right? So the issue with that is what they're going to do is they're going to have a 20% withholding, right? And so mandatory, no matter what. So especially when they, like I said before, when they issue the check to you. If you don't roll that into something within 60 days, you're going to A, incur that as income, and B, you may have a 10% penalty, right? Another issue is that if with a 20% withholding, you actually still need to come up with the cash prior to your IRS filing date to put into that, to replace that 20%, to make sure that that rollover is whole. Otherwise, they're going to count that 20% as income, and you're going to still continue to keep that as taxed money, right? So you have to really be sure that you A, roll it over, but B, that you fund the rest of it so you have a full rollover of the amount of money that you withdrew from your other plan. I hope that makes sense. So some things to remember: cashing out can really be costly. I've seen it before, and it's really unfortunate, especially the long-term impacts on it. And these plans really are designed to be long-term investments. it tends to have a really big impact on your success in retirement, right? Compounding can help you grow your savings. So making sure that the rollovers are clean, that it's direct, and that you invest in the right things is a big deal. A rollover IRA is probably going to offer you a lot of flexibility. If you haven't thought about it, I think it's a really good time to think about that. We help clients with that a lot. And you tend to have a better risk-adjusted return over time, and allows you to change and be more specific with the investments that you do have. And then feel free to talk to an advisor. Myself, we have other advisors at Cal Coast for. If there's an advisor you trust, talk to them. But the biggest part about having a retirement account and the retirement savings is positioning yourself correctly for retirement, right? So whether it's making up for a loss of income in retirement, or if it's estate planning, making sure that you have money for traveling, things like that, that's really where we specialize. And as helpful as the little graphs are within the plans, which says, hey, it looks like you're on track for retirement, everybody's different. Everybody's expenses are different. Everyone's needs are different. And so taking that into consideration on a very specific level is going to be very important. And so that's really all I had for the rollover portion. Again, I wanted to keep that brief and keep the options open for Q&A. And so I'll go ahead and look for these. So question number one, how does a backdoor Roth IRA works? I read that it takes into account all IRA amounts, even if only small amount is moved into a Roth. So this may limit my ability to do this. So yes. So what a backdoor Roth does is that it takes your money from a regular IRA and then you transfer it into a Roth IRA, right? You can really transfer as much as you'd like from your Roth IRA to an IRA. So that is correct. You're not limited to the normal contribution limit of $6,500 a year, for instance, right? You can transfer money from your IRA to your Roth, but it will be taxed as income. And so even if only a small amount is moved to the Roth, so this may limit the ability to do this. Is there a special type of IRA for non-deductible contributions? If my income is too high to make tax-deductible contributions to an IRA, but still want to put money into an IRA, how is the best way to do this? So if you have an employer plan, that's usually a really good way to do that, right? So if you have a 401k, that's probably the best way to do that. It seems like you may not have a 401k. And in that kind of instance, you can contribute to an IRA. It just won't be tax deductible, right? Other ways to do that, we may be able to get around, depending on your income level, how your job is situated. If you're an independent contractor or not, you may be able to set up things like a solo 401k or a SEP IRA, and you may be able to make contributions to those and be tax deductible, even if your income's higher, right? There's certain considerations when you do that, and if you want to, chat offline, I think we're going to put up my email. So I'll put my email down here, but we can have that conversation. But there are some limiting factors within that space, and you have to be specific with how you're getting paid, and maybe a SEP IRA may be a good option. It may not be a good option. Other than that, a regular investment account is still a great vehicle, right? So if you have a regular brokerage account and you want to invest, growing your money is really the most important thing that you can do for retirement. Whether it is in a retirement specific account or not, it's still much more beneficial to have growth, even if it's not tax deferred growth. So I'll put my email address. There you go. Now, does anybody have any other questions aside from that? Okay, what percentage of your working years income do you suggest for a comfortable retirement? There's some rules of thumb, right? So some of the rules of thumb are 3 to 4 years of working income to be comfortable in retirement. But that really is going to depend, right? Really, the basic calculation that you really want to look at is, what is my income in retirement? What are my expenses right now? You should expect those expenses to be about 80 to 90% of what your expenses are now in retirement, right? What's it going to take to bridge that gap, right? And then once you find that amount from what you can do to bridge that gap, okay, well, what kind of return is it going to take out of my assets in order to make that kind of return, right? So let's just say at a rate, a nominal rate of whatever you're, and this comes down to risk tolerance, right? But 7%, 6%, if I can make 6% over time, is my portfolio big enough to bridge that gap, right? How long will it last at that kind of withdrawal rate? And we can do some calculations based off of that. But there are some general rules of thumb. And if you Google that question, there's probably going to be about 4 different answers out there. So can you go over traditional versus Roth IRA? Yes, I certainly can. So a traditional IRA is going to be money that you contribute from from either your paycheck right now, it'll be taken out of your paycheck through your company in a 401k, or if you're contributing it to an IRA, you're just going to put money into it. But that money is deductible now, so it's tax deductible now. So let's just say right now you make $100,000, you put $5,000 into your IRA. It's going to look like to the government that you made $95,000 this year, right? So you take the tax deduction now, and it grows and grows and grows and grows. And when you get into retirement, then that amount is going to be all taxable. So if you take money out of it, it's going to be taxable as income, right? So let's just say you need, the issue with that, and that's why it's important to have a couple of buckets in retirement as well, right? So the issue with that is that having everything, I've had clients with a really big IRA, which is great, right? You get into retirement, and let's just say you have a home repair, right? Or you want to do an addition, or you want to do something else. And now you have to take $100,000 out of there, right? Well, now you have $100,000 coming in, and that's going to be taxable as income, right? So income taxes versus capital gains taxes. Or in a Roth, if you have part of your money in a Roth, what you could do is you can kind of split it, right? You say, okay, I'll take 50 out of this, 50 out of this, whatever keeps you within your tax bracket. You can at least kind of have, play a little bit of a shell game with the IRS in order to make sure that not all of your money is taxable, right? The Roth IRA is the exact opposite, right? So the Roth IRA, you get taxed on the money just like you normally do in a paycheck, right? You contribute it, right? As if you were investing in a normal investment account, except for all the dividends, all the capital gains at 59.5 when you can take that money out, that's all going to be tax-free, right? So you're starting with a smaller amount, and then you're getting, and then it's tax-free when you take it out, right? Versus now you're starting at a bigger amount, but it's all taxable when you take it out, right? And I get a lot of questions on which is the best. Well, really, what it boils in the equation ends up being the same about, but really it's, are you making more now than you will be when you retire, right? And if you're making more now than you will be in retirement, then probably the traditional IRA is a good idea. Again, it's important to have both. So I would say the flexibility is a big benefit as well. So if you don't have anything and you're making a lot of money anyways, I would still contribute a little bit to the Roth, even though it's not technically the most, statistically best thing for you, right? But again, I think it's a really good idea to have, if you're making more money now than you will in retirement, go traditional, Roth. If you're not in your prime earning years, then a Roth is a really great option for you. What is the typical cost for portfolio management, and what are some tips for choosing a reputable and qualified financial advisor? Good question. The typical cost for portfolio management is typically between is if you're doing asset based. So there's some advisors that will do, transaction based. That's a little bit antiquated and tends to, be a little bit less compliant because people will essentially there's a churning and a I guess there's some issues with it as far as being what's in the best interest of the client, right? So normally in an asset-based type of model, which is what most advisors will do, it's probably between 1 and 1.5%, depending on the size of your portfolio. And finding a reputable and qualified advisor, it really depends. There are some designations that people have, AAMS, CFP, things like that. But I think, talking to somebody and getting a good idea of their management style, things like that, is a great place to start. Reaching out, having a phone call, asking about, investment policy, things like that, I think is a good start. But again, just trust is probably the biggest issue that people run into when trying to find an advisor. But again, there are different designations for people. And so sometimes, convenience is good too. So having somebody that's near you, local, is a good thing to have. What are your thoughts on broker apps? So I assume this is maybe a Robinhood E-Trade type of question. I think they're great. So, if you want to trade and buy stock and run a portfolio for yourself, I think it's a great low cost way to do that, right? The problem is, the reason that we're employed is that oftentimes there are investments that some people might have, and there are decisions that people might make that may not be the most well thought out, right? Especially when you're coming to retirement and there's issues with safety and volatility, right? So, I think that brokerage apps are great. You just have to know what you're doing and just do your research before making any big decisions with your investments, right? And make sure that it's in line with A, your risk tolerance, and B, your financial plan, so your outlook for retirement, right? So I hope that was some good questions. I hope I can answer everything for most people. Let's see here.
All right, thank you so much,
Kyle. I
Kyle.
always get a question on cryptocurrency. Cryptocurrency, I think it's promising, but I would say don't put in any more than willing to lose, right? So it's more speculative in nature and could go great, but it also could disappear. So unlike traditional stock, where the company is not really going to be going anywhere, there's one currency may take the reins over another, or maybe China comes up with their own. There's a lot of things that could just really kind of tank certain cryptocurrencies. So be careful. Don't put in any more than you're willing to lose. That's all I'll say.
Sound advice, for sure. Well, thank you very much, Kyle. This has been really informative. And thank you, everyone, for all the great questions. I just want to mention that CalCoast offers a financial wellness platform on retirement, or that has information surrounding retirement, but also a large number of other financially related topics. There's videos, articles, courses, tools, games, webinars, all types of things that you can access, and it's all free. I'm going to put the link in the chat. You can check it out anytime you'd like. There's even a personality assessment. It's called the Your Money Personality Assessment on there, where it will have you answer a few questions, and then it'll kind of give you an itinerary, or not itinerary, kind of like a course criteria and some other things. It'll basically create content that's customized to you. So if you have a lot of questions surrounding retirement, it will catch that, and it'll bring up some videos and articles and courses and things that you can do to answer more of your questions that you might have. And just want to mention also that becoming a member of CalCoast is free. Scheduling some time with Kyle is free. As a credit union, again, we're not for profit. We do offer a lot of free products and services. So if you are interested, again, there's going to be an evaluation form that pops up, or survey rather, once we conclude today. So you can indicate that you'd like us to follow up with you. Or Kyle, do you want to go ahead and put your contact info into the chat? That way, if anyone wants to follow up with you directly, they can do so.
Sure.
That would be great.
Yeah.
And then, oh, sorry, go ahead.
Yeah, I'll do that.
Okay, awesome. We also have our website. You can always go to our website. We have monthly webinars that we offer to our members, but you're welcome to join as well. They're open to whoever would like to join us. Those are listed on our website as well as the Enrich portal that I just mentioned previously. And we have a YouTube channel too, so you can check out our YouTube. There's all kinds of financial wellness videos and resources there for you. And again, it's all free. So access that anytime, contact us anytime. We want to answer any questions you might have. If you are interested in becoming a member, we actually pay you to do so. So we have a promotion that we can offer to you for that as well. So contact us and we'll help you out. But for now, I just want to say thank you to Kyle, and we'll see you next month. We are doing a presentation again. It'll be on a different topic, but you can check out the library website, and it'll be listed there for you as well. So thank you, Kyle, and we'll see everyone next time.
Yep. Feel free to reach out if you have any specific questions to you. So more than happy to answer. So shoot me an email. Happy to chat.
Great. All right. Thanks so much, everyone.